Silver just got destroyed. Look at this chart. Silver opened today at $96. Right at the open, it started selling off, dropped all the way to 92. Then it recovered, fought its way back to 96. And just when it looked like the selling was done, just when people thought the worst was over, it got hit with a sudden $10 crash. 96 to 86. Over 10% gone in one move. While a war is raging in the Middle East, while missiles are flying, while the Strait of Hormuz is being choked, a $10 crash out of nowhere after it had already recovered from the first sell-off. That is the kind of move that shakes people out of positions. I need to walk you through exactly what happened, exactly why it happened, and then I am going to tell you the honest truth about what I am watching right now to figure out if this is the buying opportunity of the decade or the start of something worse. Stay with me on this one because I'm going to show you data today that changes how you look at this entire move. But first, I need to address something because I know exactly what some of you are thinking right now. In my last video, I told you 5,400 was the last line in the sand for gold. I told you that was the level. The one that either breaks and sends us into open air or rejects hard and reminds everyone that resistance is real. This morning, gold gapped at the open from 5,278 straight to 5,400 with no trading in between, just a vacuum. It even tagged 5,418 before getting hammered back down to 5,265. The resistance held on the first attempt, and that part I called correctly. What I did not fully emphasize was how violent the rejection could be and how aggressively it would spill into silver. So let me break the entire sequence down clearly and without emotion, because the details matter here more than the drama. Hey, James here. This is Noble Metals. If you're new here, press subscribe button right now. Comment. Which country are you from? A $100 plus gap in the blink of an eye tells you something massive about weekend risk. The war headlines, missile footage, threats to shipping routes, geopolitical escalation, all of it got priced in at once. That kind of gap is panic buying compressed into a single print. But when gold gaps directly into a major resistance level, two outcomes are possible. Either momentum explodes through and sellers get steamrolled, or sellers defend the level with everything they have and slam it back down. Today was the second outcome. Gold hit 5,418 and within hours was back at 5,265, filling the gap quickly and aggressively. The key question is what that rejection actually means. Most people are reading it wrong. They see rejection and assume failure, ceiling, rally over. That interpretation is lazy and ignores structure. The correct way to read it is this. Gold was at 5,230 on Friday and is sitting around 5,300 after a violent round trip. It ran into resistance, pulled back to prior traded volume around 5,265, and then recovered. That is not a collapse. That is a first test. First tests of major resistance levels almost always fail. What matters is whether price disintegrates afterward. It did not. The demand that created a $100 gap did not evaporate. It simply hit a wall. It was not yet ready to break. When a gap up gets rejected but price refuses to break down, the second test often succeeds. The sellers who defended 5,400 used significant ammunition on that first defense. They are not stronger. They are more exposed. The buyers who stepped in are still there, reloading rather than abandoning their thesis. Now, let's discuss the mechanics of gap ups because this is critical. When gold jumps from 5,278 to 5,400 without building support underneath, there is no structure in between, no base, no consolidation, no layered bids. That means if resistance rejects price, it falls through empty space until it finds real trading volume. That is exactly what happened. Gold sliced back down to 5,265, where prior transactions existed and stabilized. Gap fills after first resistance tests look terrifying but are often healthy. They force the market to build support the hard way by trading, accumulating, and creating a base. The first attempt at resistance was a raid. The second attempt, if structure forms beneath it, becomes a siege. And sieges succeed when supply weakens over time, while demand remains persistent. Silver is where the emotional damage occurred. Silver dropped from 96 to 86, more than 10%, while gold moved roughly 3% from high to low. This is not manipulation, it is leverage. Silver is a leveraged expression of gold. When gold rises 5%, silver often rises 10 or 15. The reverse is also true. The leverage works both ways and cannot be separated. Today's 3 times amplification is consistent with silver's historical behavior. If you participate in silver for upside acceleration, you must accept downside acceleration as part of the same contract. That volatility is not a bug. It is the feature that creates outperformance during rallies. The same multiplier that punishes during corrections, rewards during breakout. Understanding that relationship prevents emotional liquidation at structurally important moments. Here is where things get interesting. While the Western futures price dropped roughly $10, the Shanghai futures price fell about half that amount. The divergence widened to roughly a $16 premium for the same underlying metal. That matters. When paper markets sell off more aggressively than physical markets, it suggests futures positioning is driving price more than real-world demand destruction. Divergences between paper and physical eventually resolve, and historically they resolve in the direction of physical demand. Futures, contracts, are financial instruments. Physical metal is the deliverable asset industries and investors actually require. If the Eastern physical market holds firmer than the Western paper market, that gap becomes a signal rather than noise. It indicates the correction may be more about leverage unwinding than collapsing fundamental demand. Now consider delivery data. In March silver, 306 contracts stood for delivery in a single day, bringing the month-to-date total to 4,846 contracts. At 5,000 ounces per contract, that is 24.23 million ounces demanded in just the first few days. During a 10% price drop, major institutions are taking delivery rather than stepping aside. On gold, delivery activity also continued, with large banks both issuing and stopping contracts. The key takeaway is behavior during volatility. Institutions are not fleeing metal while paper prices fall. They are moving physical inventory. That distinction is essential. When price drops but physical uptake remains steady or increases, it suggests long-term positioning rather than short-term panic. Delivery pace during weakness can become fuel for future price acceleration if supply tightens. Meanwhile, bonds fell during geopolitical stress. Yields on short and long-term government debt rose as inflation concerns dominated safe haven flows. Oil-related disruption fears are complicating monetary policy expectations and pushing rate cut timing further out. The environment creates a policy trap. Cutting into inflation risks fuels price pressures. Hiking into geopolitical stress risks recession. When central banks are constrained, gold historically performs well because uncertainty increases and confidence in policy control decline. A paralyzed policy backdrop tends to support hard assets. If capital begins reassessing traditional safe havens and reallocating even marginally, the impact on metals markets can be significant over time. This macro layer reinforces, rather than contradicts, the technical structure building beneath current price action. For gold, the structural threshold is clear. A sustained break below 5,000 would signal character change. A rejection at 5,400 after a vertical gap does not. Every hour, gold holds above 5,200. It builds foundation. Consolidation after violent movement is how markets prepare for second attempts. If catalysts persist and demand remains intact, the probability of another test of 5,400 increases. The sellers who defended the first move expended liquidity and positioning to do so. Repeated pressure at resistance typically weakens that barrier. The structure now depends on stability rather than acceleration. Stability supports continuation. Collapse negates it. So far, stability is what the chart shows. For silver, 85 to 86 represents near-term structural support. The move from the low 70s to 96 built a staircase driven by war premium and supply risk. The pullback has retraced roughly half of that advance. Partial retracements after parabolic advances are normal in every historical silver bull phase. If 85 holds on daily closes, silver has room to base and attempt higher levels later. If 85 breaks decisively, mid-70s become possible, shaking out late entrants. That is the reality of leveraged instruments. The level is clear and measurable, removing emotion from the equation. Structure, not sentiment, determines next direction. Going forward, focus on 4 indicators. First, whether gold retests 5,400 quickly. Fast retests often break. Second, whether the physical premium in Shanghai remains elevated. If divergence persists, paper weakness may prove temporary. Third, whether delivery demand sustains pace. Large physical uptake during price softness is constructive. Fourth, whether geopolitical conditions materially change. If escalation continues and supply routes remain pressured, risk premium persists. Monitoring these elements replaces narrative-driven trading with data-driven observation. What would change the thesis? A sustained close below 5,000 inches gold across multiple sessions would indicate structural breakdown. A collapse of the physical premium by Eastern prices falling rather than Western prices rising would confirm physical weakness. A sharp drop in delivery participation would imply institutional appetite fading. A verified and lasting geopolitical resolution would remove war premium. As of now, none of those conditions exist. Prices corrected. Fundamentals did not reverse. Distinguishing between price volatility and structural change is critical in high beta environments. To those holding silver through the drop, ask whether your core reasons for ownership changed. If not, price volatility alone does not invalidate thesis. To those waiting for dips, this pullback represents the type of retracement frequently requested during uptrends. Markets rarely provide comfortable entries. They provide volatile ones. The rejection at 5,400 was a first attempt, not necessarily a final verdict. Silver's drop reflected leverage dynamics, not isolated collapse. Physical demand remains active. Delivery continues. Macro uncertainty persists, and policy remains constrained. If structure holds and catalysts continue, the next test of resistance will arrive. How participants respond to volatility often determines whether they benefit from continuation or exit before it occurs. Drop a comment. Tell me if you think 85 holds for silver. Tell me if gold tests 5,400 again this week. Tell me if you bought the dip or if you are waiting. I want to hear it. Share this video right now. There are people in your life who bought silver in the 9S, and they are panicking today because they do not understand what I just showed you. The paper market and the physical market are telling two different stories. Help me reach them before they sell the bottom. If you are new here, go watch the last 3 videos. I called 5,400 as resistance. I called the war escalation. I called the silver volatility. Every one of those calls is on camera. Real gold is rare, but real truth is rarer. Let's find it together. This is Noble Metals. I'll see you in the next one. Stay skeptical, stay informed.